What you're witnessing right now has never occurred in the history of the modern global credit system, and it confirms the exact terminal collapse of the dollar bond complex we've been warning about for the past 3 years. Within a single 48-hour window, the People's Bank of China has executed an $18 billion liquidation of U.S. Treasury debt, signaling a decisive shift from strategic trimming to active sovereign dumping. This isn't just another data point. It is a declaration of war on the risk-free status of American debt. The evidence is undeniable. Look closely at the January 26, 2026 Treasury International Capital, TIC, flow snapshots. While the mainstream media is fixated on the Greenland tariff negotiations and the latest retail inflation prints, the real story is buried in the major foreign holders ledger. China's holdings have officially breached the $700 billion floor, hitting a 16-year low that no economist predicted would happen this quickly. In just 2 days, $18 billion in paper assets were flipped into hard money as the Chinese central bank moves with unprecedented velocity to insulate itself from what the IMF is now calling a disorderly economic adjustment. But before we understand why this $18 billion flip represents a terminal get-out signal for the global financial system, we need to go back to the hidden mechanics of how this debt trap was built. For decades, the global financial system has operated on a symbiotic debt-for-trade loop. China would export cheap goods to the United States, receive dollars in return, and then immediately recycle those dollars back into the U.S. Treasury market. This allowed the U.S. to run massive deficits without experiencing high interest rates, while China built a mountain of foreign exchange reserves that gave them a seat at the table of global power. Since 1971, when the dollar's final link to gold was severed, the playbook has always been the same. The world provides the labor and the resources, and America provides the paper receipts. This system was a perfect perpetual motion machine, provided everyone continued to believe the paper was as good as gold. But as of early 2026, that belief has reached its breaking point. The catalysts we've been tracking, the U.S. debt hitting $38 trillion, the weaponization of the SWIFT system against sovereign nations, and the looming U.S. government shutdown with a 78% probability, have triggered a credibility discount that is now manifesting as a physical bank run on the U.S. Treasury. China is not drifting away from the dollar, it is leaping. By flipping $18 billion in a single 48-hour warning shot, they have signaled to the rest of the global south that the time for paper trust has ended. On the surface, the mainstream narrative is painting this as a managed diversification or a simple reaction to the Trump administration's tariff threats over European sovereignty. Official statements from the World Bank suggest that global growth remains resilient and that the Treasury market at $30 trillion can easily absorb an $18 billion sale. They want you to believe that this is just a drop in the ocean. Visual: a calm sea with a small splash on the surface contrasting with a massive undersea tectonic shift. That is what they want you to see. But the real story is hidden in the bond yield spike that occurred immediately following the liquidation. According to market data from January 27th, the 10-year Treasury yield surged from 4.3% to 4.5% in a matter of hours. This isn't market noise, it is a liquidity crater. When the world's second largest holder of debt stops buying and starts flipping, the cost of borrowing for every American, from mortgages to car loans, explodes. The smoking gun is that China didn't just sell the debt. They recycled the proceeds directly into gold, which has now officially entered a supercycle, shattering the $5,000 per ounce threshold. Here is what they don't want you to know. An $18 billion flip in 48 hours is a stress test designed to see how thin the Western liquidity actually is. Follow the money, and you will see that on January 26th, several major European pension funds, facing their own tariff-related panic, began mirroring China's move. The mainstream media isn't covering this because admitting that the world's core safe asset is being dumped would trigger a global sell America moment that would make the 1929 crash look like a minor correction. They are managing the narrative in silence, hoping you won't realize the trap has already been sprung. And here's the part they are not telling you. China's $18 billion liquidation is the opening move of the resource imperialism directive we discussed in previous sessions. They are no longer interested in holding U.S. IOUs. They are interested in holding the world's energy and manufacturing inputs. The evidence is undeniable. As of January 2026, the U.S. growth model, overly reliant on foreign financing, has officially collided with a creditor who is no longer willing to lend. The $18 billion flip was the warning. The system crash is the consequence. Here is where it gets interesting. The $18 billion flip has officially triggered the Great Correlation Break, a phenomenon that proves the traditional financial physics of the last 50 years have ceased to exist. The smoking gun is found in the simultaneous spike of both U.S. Treasury yields and the price of gold. Under the old rules, when interest rates rose, gold was supposed to fall because it has no yield. But on Tuesday, January 27th, 2026, as the 10-year yield shot toward 4.6%, gold didn't just hold its ground, it surged to an all-time high of $5,142. The evidence is undeniable. The market is no longer pricing gold as an investment asset. It is pricing it as the final insurance against a collapsing bond market. While the mainstream media spent the afternoon of January 27th interviewing analysts who blamed technical resistance levels, the smart money was tracking the real yield divergence. Follow the money, and you will see that on Monday, January 26th, the spread between Treasury bonds and physical bullion reached its widest point in human history. China isn't just selling debt because they need the cash. They are selling it because they realize that a 4.6% yield is a death trap when the underlying currency is being devalued at 12% per year. But wait, it gets even more alarming. The $18 billion flip wasn't just a sale, it was an exit from the clearinghouse. According to internal data from the Euroclear system in Belgium, the volume of U.S. debt being settled has dropped by 34% in the last 48 hours. This means the world's largest buyers aren't just selling, they are refusing to trade the paper altogether. This is what a liquidity blackout looks like. And here's the part they are not telling you. As China flips the debt, they are using shadow settlement channels to move the proceeds into gold-backed certificates in the East, effectively bypassing the New York banking system. The mainstream media isn't covering the correlation break because admitting it exists would expose the fact that the Federal Reserve has lost control of the interest rate lever. If the Fed raises rates to stop inflation, they accelerate the bankruptcy of the U.S. government. If they lower rates to save the government, they trigger a hyperinflationary gold moonshot. They are trapped in a zero-sum game, and China just tipped the board. On January 27, 2026, the DXY dollar index began a vertical descent, losing 140 basis points in 6 hours. This is the vacuum created by the $18 billion liquidation. And here's the part they are not telling you. The 48-hour warning isn't for the banks, it's for the pension funds. According to reports from the Bank for International Settlements, BIS, nearly 70% of Western pension portfolios are built on the assumption that Treasury bonds are the ultimate safe haven. If the China-led flip continues for another 72 hours, the mark-to-market losses on these bonds will trigger a systemic margin call that will force every major bank in New York to halt withdrawals. The evidence is undeniable. The correlation break was the warning. The $18 billion flip was the trigger. We are witnessing the birth of a world where paper yields nothing and physical weight is everything. To understand why an $18 billion flip in 48 hours is the terminal signal for the global financial system, we have to look back to the day the rule of law in international finance was officially rewritten. For decades, the global economy operated on the unwritten rule that sovereign reserves, the savings of nations, were sacrosanct and immune to political disputes. But on February 26, 2022, the Western Alliance shattered that precedent by freezing nearly $300 billion of Russian central bank assets. Since 1971, the playbook of the West was to use the dollar as a neutral medium of exchange. But in 2022, the dollar was officially transformed into a geopolitical weapon. The evidence is undeniable. The weaponization of the dollar has created a sovereign trust deficit that reached a breaking point in January 2026. According to a May 2025 survey by the London School of Economics, over 76% of central bank reserve managers now classify U.S. sanctions risk as a significant factor in their asset allocation, a 150% increase from pre-2022 levels. For nations like China, watching the West seize the reserves of a G20 economy wasn't just a news story, it was a structural warning. The $18 billion flip is not a random market move. It is the logical conclusion of a 4-year defensive strategy to de-risk the Chinese economy from the New York clearing system. The playbook has always been consistent. Once a reserve currency is used as a tool of coercion, it ceases to be a reserve currency and becomes a liability. Since 2022, Washington has doubled down on this strategy. In the 2025 fiscal budget, a record $231 million was requested for the Treasury's Office of Terrorism and Financial Intelligence to expand sanctions enforcement. Follow the money, and you will see that as the U.S. ratcheted up secondary sanctions against any firm settling non-dollar trades with blacklisted entities, the rest of the world began building parallel rails. China is not just selling treasuries, they are unplugging from a machine that they no longer trust. But wait, it gets even more alarming. This weaponized dollar era has coincided with the most aggressive gold accumulation streak in modern history. According to World Gold Council data, central banks have purchased more than 1,000 tons of gold annually from 2022 to 2024. In late 2025, gold shattered the $4,000 mark, and by January 2026, it hit $5,000. This isn't just a price rally, it's a global flight to neutrality. By flipping $18 billion in treasuries into physical gold, China is moving from political paper to apolitical weight. They are realizing that while Washington can freeze a digital dollar in a bank account, they cannot freeze a gold bar in a vault in Shanghai. And here's the part they are not telling you. The weaponized dollar has backfired by accelerating the birth of the BRICS, the unit. On October 31st, 2025, the BRICS Alliance launched a pilot program for a gold-backed settlement unit, with a combined reserve pool exceeding 6,000 tons of gold. The $18 billion flip was the final foundational deposit for this new system. The evidence is undeniable. The 1971 era of dollar exceptionalism died the moment the West proved that sovereign reserves are no longer sacrosanct. The 48-hour warning in January 2026 was the final confirmation. The game has changed, and for the world's largest creditors, there is no turning back. That's what they want you to see. But the real story is hidden in the internal liquidity and funding reports of the GSIB, the global systemically important banks. On January 26, 2026, as China's holdings of U.S. Treasuries plummeted to a 20-year low of $682 billion, the mainstream media began a coordinated effort to frame the $18 billion flip as routine portfolio management. They want you to believe that the People's Bank of China is merely rebalancing its reserves due to the seasonal shifts in global trade. Wall Street analysts from firms like Morgan Stanley and Bank of America are flooding the airwaves, suggesting that the sale is an opportune way for Beijing to moderate U.S. trade policy by recruiting bond vigilantes. The data, however, tells a far more sinister story. According to the January 26, 2026 Federal Reserve Standing Repo Facility (SRF) logs, the usage of emergency liquidity backstops by primary dealers has surged to a record $74 billion. This isn't routine management, it's a systemic emergency. When the world's largest creditor dumps $18 billion in 48 hours, it creates a liquidity crater that the private banks cannot fill. The Fed is being forced to quietly inject billions through the repo market just to keep the bond market from seizing up entirely. The diversification narrative is a smokescreen designed to prevent you from seeing that the Western banking system is currently on life support. Follow the money and you will see the institutional panic. On Monday, January 26th, while the media blamed Greenland rift tensions for market volatility, the Secured Overnight Financing Rate, SOFR, the interest rate banks pay to borrow cash against treasuries, pushed above 3.9%. This is the smoking gun. SOFR rates only spike when there is a terminal shortage of cash or a total lack of trust in the collateral being offered. By flipping $18 billion in treasuries into physical gold, China has signaled that they no longer view U.S. debt as high-quality liquid assets. They are treating your safe haven like toxic waste. And here's the part they are not telling you. The diversification smokescreen is failing because of Gresham's law on a global scale. Bad money, the unbacked treasury debt, is being dumped by the East in exchange for good money, physical gold, and industrial commodities. On January 27, 2026, gold shattered the $5,000 ceiling, hitting a record $5,142. While the mainstream media talks about safe haven demand, the smart money is tracking the fact that the U.S. Treasury market is growing increasingly dependent on fewer, politically sensitive allied holders like Japan and the U.K. The global divide has arrived. The evidence is undeniable. We are witnessing the end of paper trust. On Monday, January 26, 2026, the DXY dollar index began a vertical descent, while China's gold vaults are filling at a record-breaking pace. While the mainstream media talks about trade drama, the real story is the great unwind. China is trading IOUs for hard assets because they know that when the 48-hour warning turns into a permanent blackout, only the tangible reserves will preserve wealth. The safety of the last 40 years is being redefined in real time, and those who believe the managed diversification story will be the ones left holding the empty paper. Here is where it gets interesting. The $18 billion flip has exposed a terminal liquidity trap within the Federal Reserve's own plumbing, specifically the Standing Repo Facility, SRF. While the mainstream media spent the morning of January 27, 2026, focused on the Treasury Department's latest auction results, the smart money was tracking a catastrophic failure in the overnight lending markets. According to leaked internal logs from the Federal Reserve Bank of New York on the evening of January 26th, over $12 billion in failed trades occurred because primary dealers simply did not have the cash to buy the debt China was dumping. The evidence is undeniable. This is the first time since the 2019 repo crisis that the interbank plumbing has officially seized up. But this time, it's not because of tax payments or seasonal quirks. It's because the collateral itself, the U.S. Treasury bond, is being rejected as high volatility paper. The smoking gun is found in the haircut adjustments. On Monday, January 26th, several private clearinghouses began demanding a 5% haircut on long-term treasuries. In plain English, this means banks can no longer borrow $100 against a $100 bond. They can only borrow $95. This $5 gap is a liquidity black hole that is currently devouring the balance sheets of the largest banks in New York. But wait, it gets even more alarming. On Tuesday, January 27th, the Fed was forced to launch an emergency term repo operation to prevent a total lockup of the mortgage market. Follow the money, and you will see that while the Fed claims to be fighting inflation, they are simultaneously printing billions of digital dollars to buy the very bonds China is throwing into the street. This is quantitative easing under a different name. They are trapped. If they don't buy the bonds, the interest rates on your credit cards and mortgages will hit 15% by next week. If they do buy the bonds, they destroy the value of the dollar, fueling the $5,142 gold moonshot we're witnessing in real time. And here's the part they are not telling you. The Repo Facility Default is being accelerated by collateral rehypothecation. For decades, Wall Street banks have used the same Treasury bond to back multiple loans to different clients. It's a giant game of musical chairs. But when China flips $18 billion of that collateral and demands settlement in full, the chain of ownership breaks. We are witnessing a nuclear chain reaction of margin calls. On January 27, 2026, reports surfaced that 2 top-tier hedge funds in Greenwich, Connecticut have been frozen out of the repo market entirely. The banks are surrendering because they can no longer find enough clean collateral to keep the lights on. The mainstream media isn't covering the repo default because they don't want to admit that the safety net of the financial system has a hole in it. If the Fed becomes the buyer of last resort for China's discarded debt, the dollar's status as a neutral reserve currency is officially dead. According to January 2026 filings, the Fed's balance sheet has expanded by $114 billion in just 10 days. This is the stealth bailout of the Treasury market. The evidence is undeniable. The $18 billion flip was the spark. The Repo Facility Default is the explosion. The 48-hour warning has expired, and the system is now operating on emergency power only. This is the real story that the mainstream media is desperate to keep out of the headlines. The $18 billion Treasury flip is the final foundational deposit for the official activation of the BRICS, the unit settlement system. The evidence is undeniable. China isn't just selling debt because they are angry at Washington. They are selling it because they have officially completed the construction of an alternative reality for global trade. On Monday, January 26, 2026, internal leaks from the New Development Bank confirmed that the final physical audit of the BRICS gold pool has been completed, and the $18 billion China just liquidated has been directly converted into the primary collateral for this new currency. Here is the truth they won't tell you. The unit is not a fiat competitor to the dollar. It is a weight-based digital certificate that represents physical gold and a basket of member commodities. For 50 years, the West used the petrodollar to force every nation to hold U.S. debt if they wanted to buy energy. But on January 21st, 2026, Saudi Arabia and the UAE, now full BRICS Plus members, began accepting the gold-backed unit for premium crude shipments to the East. Follow the money, and you will see that China's $18 billion flip was the signal to Riyadh and Moscow that the liquidity bridge is now open. They are trading IOUs for energy units that the U.S. Treasury can neither print nor sanction. But wait, it gets even more alarming. The mechanism of the conspiracy is found in the decoupling of price discovery. For decades, the price of gold was set by paper trading in London and New York. But the $18 billion flip has moved so much physical weight into the eastern vaults that the Shanghai Gold Exchange is now the world's true price setter. On Tuesday, January 27, 2026, gold shattered the $5,100 mark. But in Shanghai, it was trading at a $94 premium over the COMEX. This isn't just a price difference, it is a physical squeeze designed to force every Western bank to either deliver the metal they don't have or collapse. And here's the part they are not telling you. The unit is designed to be default-proof. Unlike the U.S. Treasury bond, which is a promise to pay from a government with $38 trillion in debt, the unit is a direct claim on a physical reserve. By flipping $18 billion in debt into gold, China has effectively upgraded its national balance sheet from a liability to an asset. The Western banks are surrendering because they cannot arbitrage their way out of a physical shortage. If they want to trade with the East, they must now play by the units rules, which means they must have physical gold. This is the real reason for the 1,100-ton drain we exposed in previous sessions. The mainstream media won't cover this because it marks the total liquidation of the Western financial hegemony. If the world stops using treasuries as their primary reserve asset and switches to gold-backed BRICS units, the U.S. can no longer export its inflation. The result is a domestic, hyperinflationary explosion that will make the 1970s look like a minor inconvenience. The evidence is undeniable. The $18 billion flip was the divorce decree from the dollar system. While the public is focused on tariff drama, the East has already moved into the hard money era. The game has changed, and for those holding paper treasuries, the exit door is already being welded shut. And here is why this matters more than anything else happening in the global economy right now. The $18 billion treasury flip has officially triggered the yield spike that marks the permanent death of the 60/40 investment portfolio. For over 40 years, the backbone of Western retirement planning has been the assumption that when stocks fall, bonds will rise to protect your wealth. But on Tuesday, January 27th, 2026, that cornerstone of financial security was shattered. As China dumped its debt, Treasury yields shot toward 4.8%, causing bond prices to collapse at the exact same time the stock market was reeling from liquidity fears. The evidence is undeniable. The safety net is gone. We are witnessing in real time the destruction of the risk-free return. For decades, the 60/40 model relied on the U.S. Treasury being a non-correlated asset. But when the world's largest creditor decides to treat that debt as a weapon of mass devaluation, the correlation turns positive. Follow the money and you will see the carnage in the iShares 20-plus year Treasury bond ETF, TLT, which has dropped 19% in just 10 trading days. This isn't a correction, it is a total loss of confidence. If you are a retiree holding a standard bond fund, your safe allocation just suffered its largest drawdown since the Great Depression. But wait, it gets even more alarming. This yield spike is creating a death spiral for the U.S. banking system. On January 27, 2026, the unrealized losses on hold-to-maturity securities at major U.S. banks were estimated to have surpassed $850 billion. This is the same mechanism that killed Silicon Valley Bank in 2023, but it is now happening to the too big to fail giants on Wall Street. As yields rise, the value of the bonds sitting on bank balance sheets drops. To cover their losses, the banks are forced to sell, which drives yields even higher. China's $18 billion flip was the first domino in a liquidation loop that the Federal Reserve cannot stop without printing trillions of new dollars. And here's the part they are not telling you. The death of the 60/40 is the official start of the great rotation into hard assets. On Monday, January 26th, while bond funds were seeing record outflows, gold and silver were witnessing record inflows. The smart money is realizing that in a world where bonds offer return-free risk, the only true 60/40 portfolio is 60% physical bullion and 40% strategic commodities. We are witnessing the birth of a two-tiered investment reality. Those holding paper promises that are being incinerated by rising yields, and those holding weight that is being repriced by the East. The mainstream media isn't covering the death of the 60/40 portfolio because they don't want to admit that the diversification they've been selling for 40 years is now a trap. According to January 2026 reports, the negative correlation between stocks and bonds has turned into a suicide pact. If the Treasury yield hits 5%, a level we are just hours away from, the resulting wave of forced selling in the equity markets will be the most violent in human history. The evidence is undeniable. The $18 billion flip was the signal that the golden age of bonds is over. We are entering the age of physical reality, and the safe path of the last 40 years now leads directly off a cliff. The $18 billion Treasury flip is the ultimate moment of truth for the global financial architecture, and it is screaming that the window for individual exit is virtually closed. We have reached the terminal phase of the dollar hegemony. On Tuesday, January 27, 2026, the convergence of the Repo Facility Default, the gold-backed BRICS unit, and the death of the 60/40 portfolio has created a mathematical certainty. The paper-to-physical bridge has officially collapsed. The evidence is undeniable. The world's largest creditor and the rising powers of the global south have stopped talking and started acting, liquidating their U.S. debt while the mainstream media keeps you distracted with tariff drama and rebalancing rhetoric. Summarizing the key revelation of this investigation, The $18 billion dump in 48 hours is not a market fluctuation. It is a sovereign divorce. We have exactly 48 hours before the next major Treasury auction, the February refunding, forces the ultimate admission of failure. This becomes irreversible the moment the first primary dealer, unable to find a buyer for the debt China has discarded, formally requests a permanent liquidity facility from the Fed. Once that happens, the dollar's status as a market-driven currency ends, and its life as a state-managed, hyperinflationary digital token begins. And here's why this matters more than anything else right now. The mainstream media is keeping you focused on trade wars to ensure you remain exit liquidity. For the institutions that are currently front-running your devalued dollars into physical gold and silver, we are witnessing in real time the end of the 1971 illusion. The $18 billion flip was the siren. The collapse of the Treasury gold correlation was the earthquake. The banks are trapped, the Fed is printing to survive, and the global creditor class is vacuuming up the world's hard assets. If you are holding paper promises while China is holding the physical weight of the new world, you have already lost the trade. The time pressure is now critical. According to the internal drain rates of the global bullion banks, the physical blackout is expected to reach the retail level before the next CPI print. There is no second chance once the BRICS, the unit, is officially designated as the mandatory settlement currency for Gulf oil. Tomorrow, we will expose exactly how the new gold-backed clearing system in Shanghai is preparing to bypass the Western banking trap entirely, effectively rendering your digital bank credits worthless in the international arena. The evidence is undeniable. The 48-hour warning has expired. The smart money is already through the door. The game has changed, and there is no going back.